In this presentation, I'm going to talk about the history of the actuarial profession, from prior to the Institute of Actuaries formation in 1848 right through to today, 21st century. I'm going to talk about the development of the profession and in particular the education of actuaries and how that's changing in more recent times. As an outline to the presentation, I'm going to talk about why the actuarial profession at all came around, what the issue was and the science behind it. I'm going to talk about the components that were necessary, the theories that needed to come together, and how they came together in order to create the science. The development of the actuarial profession itself, the education of actuaries, and in more recent times the Morris Review, how that's accelerated the activities of universities becoming involved in actuarial education, particularly in the UK. So, thinking about the issue, well, the issue has always been there, the need of individuals to protect themselves against some form of risk, whether that be travelling on a long journey or losing a job and not being able to cover your costs, your mortgage costs and so on. Prior to the idea of insurance as a product that you could buy, the only way to deal with, say, losing a job or becoming destitute through having no finances was to actually go to charities. And that wasn't really that suitable because the solution was usually not that much of an intervention. There wasn't so much funds from charities, and also there was a stigma attached to the need to go to a charity. So obviously individuals wanted to be able to buy some form of product that was going to be theirs that they've purchased to protect them against that event. Another activity that was significant in the 1800s, the early 1800s, mid 1800s, was trade and merchant trading and shipping around the world. And obviously it was a more dangerous activity then than it is now, and so there was a need to protect against losing cargo or not making it to a particular journey. Now originally the wealthy financiers of these journeys would have just been willing for a large premium to accept financing the whole journey and the risk that those products might not make it to their destination. But it's thought to be around the 1300s to 1350 when the idea of just insuring the risk aspect of that journey came about. And what I mean by that is to say that rather than just having one financier or a group of financiers who just fund the whole project and just accept the fact that it may not ever come to fruition, that financier would finance the journey, but another financier or another group of financiers would charge a premium to take on the risk that ship might sink or whatever might happen, that the cargo doesn't get to where it's supposed to be going. It's thought that the reason that insurance created or came about was because as trade grew, and London was really the centre of trade, shipping trade, as that trade grew, then finance needed to be drawn in from more non-traditional sources. And if you go into non-traditional sources where they don't really understand the day-to-day of merchant shipping and so on, then they want some assurances themselves that their money that they're financing they're going to get their return. Okay, so the idea was that if we created these insurances, then you would get more financiers that would be drawn in and would be willing to finance these kind of journeys. In 1575, the Offices of Assurance were created in London, and that was really, I'll talk about that later on, but it was really a consequence of trying to move from an over-the-counter type trade where two people in a coffee shop would just agree this trade to something where there was a bit more protection, so that in the event that a risk materialised, the insurer would actually make the payment. Now, pre-actuarial science, or pre the actuarial science concept, because there was always a need, these sorts of products that we know today, life insurance and so on, did actually exist. So there was always a need for life insurance, there was always a need for pensions or paying somebody until they die. So the products existed, but they didn't look at all like they look today. For example, thinking about life insurance, contracts were only ever for 1 year. So you had to do, if you were going to, the risk was going to materialise if you died within the year, so more like a very short term insurance. And usually they were covering debts or travel. So if you were doing something, you you were carrying out an activity that was a little bit riskier, you might die during that year, then you might go and buy a 1-year life insurance contract. They were based on prescribed rules. For example, the 1-year contract was one of the rules. Also, insurance couldn't be purchased for more than £1,000 at a time. It's thought that William Gibbons was the first person to buy a life insurance contract. And he bought a 12-month life insurance contract, and he actually died within the 12 months, very close to the end of the 12 months. The insurance company that he bought the insurance from actually tried not to pay him out because they had based their calculations on each month being 4 weeks rather than being a full month. So you can see right from the very beginnings, insurance companies weren't too keen to actually pay out on risks. But they did try to, it went through the courts, and actually they lost in the courts, and he received his payment. The idea of a pension is a very old concept indeed. Originally, pensions weren't sold by paying a premium and you buying a percentage of salary or anything like that at all, but perhaps you may have had some land, and you would sell the land to a monastery or to a religious institution of some sort, and in exchange they would allow you to remain on the land in the property rent-free, and would perhaps pay you some form of income just to keep yourself going. The Chatham Chest is thought to be the first funded pension. The Chatham Chest was set up for naval officers, and funds were set aside in there to cover costs in the future. It's the first occasion of actually putting money aside somewhere to cover future retirement costs. The problem with the Chatham Chest was that money was never invested. The idea of compound interest wasn't included, and as more people died through war and so on, the liability on that chest increased, and so there wasn't sufficient funds. In the 17th century, retirement pensions became quite commonplace, particularly in the public sector and civil services. One strange type of pension that existed was the idea of a predecessor pension. So this was a pension where if you took up a job, as part of the package of that job, you were required to pay a pension to the person who was leaving that job. An example is of Samuel Pepys, who was clerk to the arts, and he took up the job being paid £350 a year, but as part of that he had to pay £100 a year to his predecessor, so quite a significant chunk of his income. So it was realised that predecessor pensions weren't very fair because you're really just passing the risk from one person to one other person, so you're not taking advantage of the idea of insurance, which is to bring together lots of small risks, and not all of those risks will materialise. The superannuation scheme for naval officers was set up, and this is a very significant point indeed, because it was the first state-financed superannuation scheme that was set up to cover costs until death for naval officers. The benefits were 100% of salary, and there was no retirement age, the only requirement being that you had worked in the Navy for over 15 years. Prior to the formation of actuarial science itself, there was a need for various mathematical concepts to come together. One of them we've talked about, one of those forward points we've talked about a little bit, which is the products, and the idea of pensions and insurance were always around because people weren't capable of taking on large risks themselves. But the ideas of compound interest, of probability, having mortality data to be able to work out some probabilities of death, those concepts had to evolve in order to create actuarial science. Compound interest in particular took some time to come about because it was seen as an immoral activity. Jews would have practiced money lending, but only until 1290, when they were banished from doing that, and they would have charged extortionate rates of up to 86%. So thereafter, because of that sort of bad taste that was left, if you like, it was seen as an immoral activity in the UK. In Italy, two mathematicians, Trenchard and Steven, actually created some compound interest tables at various different interest rates, where the activity was still being carried out of money lending. In fact, some of the trades that would have gone on, the merchant trading by ships from the UK, would have bought their insurance from Italy. In 1571, there was an Act of Parliament in Britain which actually allowed money lending to happen, but with various rules, and one of them being that the interest rate couldn't be above 10% per annum. In 1613, the first UK book that was created on compound interest was by Richard Witt. This is a picture of his text, and he created compound interest rate tables at various different interests, which had to be recalculated each time the interest rate had fallen. The interest rate was going through a period of falling down. Even though in Richard Witt's case all of the costs involved, all of the calculations were on certain cash flows, there wasn't any probability involved here, he did think like an actuary, and there were plenty of examples, usually based around leases, of what we would now understand to be an equation of value. One example that's in his text is a person who owes £900 in 2 years' time, but rather than paying that £900 in 2 years, would rather pay the same amount, an equal amount, every year for 5 years. And in Richard Witt's example, he goes through how you would calculate what that equal amount should be if the interest rate is 10%. And so that's very much what we understand as actuaries to be an equation of value. There were many texts that were created following Richard Witt's text. In particular, one particular text by Henry Phillips in 1654 seems to be the first text where he started to consider what the interest rate should be based on the risk. And he talks about the idea that if the cash flows are certain, fairly certain, then the interest rate used to calculate the value should be quite low, whereas if the cash flows are quite uncertain, then you should be using a higher interest rate. And this seems to be the first ideas of risk versus return. The concept of probability had a bit of a rocky start because of religious barriers. The idea being that God made all of the decisions, everything that happened was due to his plan, and the idea of chance or uncertainty just didn't come into the equation. Those barriers were broken down to an extent in 1619 when Thomas Gatzker, who was a clergyman, wrote a text where he talked about lots or leases of land, and in particular he spoke about the idea that in 99% of the cases, most of the time, chance existed, and that God only really intervened on the larger issues, bigger scale things. This really opened the door for the ideas of probability and chance to be discussed. Christian Huygens in 1657 was the first person to write a full theory on probability, and in particular he looked at expected values and talked about expectation. Obviously, as actuaries, mortality data is very, very important. Now, mortality data was kept to an extent, and there were bills of mortality for each of the major cities that were kept from 1645. John Grant, for example, analyses the London bills of mortality, but he has to make various predictions when he analyses those because ages of death aren't actually recorded, just the number of deaths and the different causes. The reason bills of mortality were created in the first place was to ensure that individuals could see when a plague or an epidemic was on its way and would be able to leave the town or the city if they wanted to. John Hood in Amsterdam seems to be the first person to look at annuity cohorts, and he did that in 1671. Here's an example of a weekly bill of mortality. This is for London, and you can see all different causes of death and the number of people who've died from those causes. So in particular, I've zoomed in there on the plague. Remember, this is just 1 week, and you can see there were over 5,500 people dying from the plague in 1 week. So it seemed now that the time was just right for these different components to be brought together. We had the products, we had the need, we had the individuals who wanted the insurance or the pension. The ideas of compound interest were created, and Witt had written a text on how he calculated compound interest and used it to work out equations of value and so on. We had Gatzker and Huygens who'd put down the foundation stones for probability theory. And we had the beginnings of mortality data. In particular, we didn't yet have Haley and mortality data by age, but that was to come. The creation of actuarial science, if you like, can really be taken right back to that in 1693 and Edmund Haley and the life table that he created. Caspar Newman, who was a minister in Breslau, actually decided to gather birth and death data in his town, his hometown, between 1687 and 1692. He was interested in science and just decided he wanted to collect this and to see what the numbers were saying. The Royal Society in London got wind of this, and they asked if he could send the data across. And so he sent the data over, and it was passed to Edmund Haley to calculate some life tables to analyse. And the real trick, or the real reason why this seems to be the creation of actuarial science, is that Edmund Haley didn't just calculate a life table. He then used that life table, combining it with the ideas of compound interest, to create a price for an annuity, for a life annuity. He then went on and looked at joint life annuities on 2 and 3 lives. Edmund Haley was only 36 at the time. Edmund Haley was only 36 at the time. He created a paper that criticised the work of Gaunt, mainly because of the estimation that Gaunt had to include, because he didn't have age in his data. But the data that come from Breslow did include age, and Haley was able to break down the age spectrum into 13 different categories and look at deaths in each category. He produced this life table, and he calculated the value of a life annuity, very much like actuaries would do today. That's an example of his life table with some of the numbers for the different age categories. London was an important place for trading, for ship trading and so on, and most of the activities, the over-the-counter activities that happened in terms of buying insurance for those trades and so on, happened in Lloyd's of London. Edward Lloyd owned a coffee house, and he would attract the shipping merchants to his coffee house by giving them good news on shipping weather and so on. And so the people who had finances to offer insurance for these journeys also gathered at this coffee house, and trades would happen over the counter. The picture on the left is just an illustration of what the coffee house might have looked like back in the 1600s. On the right-hand side is the Lloyd's of London building, which is in the same place on Lombard Street as we see it today. The problem with the over-the-counter trading that was going on was that somebody who was insuring a ship may well take the premium, but then not pay the insurance when the ship actually did crash or the cargo was lost. And this was one of the reasons why the Royal Exchange was created. The Royal Exchange was really created to bring together those people who are willing to offer insurance with those people who needed insurance, and to act as a middleman to make sure that both ends of that trade would actually be paid if necessary. After Haley, the application of actuarial science was relatively slow. Not too many people picked up on what Haley had done and using his theories to calculate the true prices of actuarial products. In the early 1700s, there were many life insurance companies set up, but most of them were set up on unsound grounds and didn't really last. One notable example is the Amicable Life Company, which set up in 1709 and offered long-term life insurance to individuals. It's thought that the calculations that they used were actuarial, but not following the methods that Haley had used. But the company had a long history, eventually being bought up by Norwich Union. Today we know that as Aviva. Alongside this, there were mathematical techniques that were being developed to try and actually reduce the amount of calculations that had to go on. For example, Demarver and Simpson were creating functions to model survival rates. Demarver's real, very simple formula was to say that the survival function was really just a linear function starting at 1 and ending at 0. This is a cover of Demarver's text in which he looked at analysing annuity prices, and he also looked at reversionary annuities and how you would calculate the price of those. A reversionary annuity is a payment that happens to an individual after the first individual has died. A key company in the history of the actuarial profession is the Equitable Life. Equitable Life was founded in 1762. James Dodson, who was a mathematical scholar, he taught mathematics for the Royal Navy for navigation, had the idea to set up a long-term life insurance company. And he analysed what might happen in the worst case scenario. And what he concluded was that the worst case scenario would be if many people bought policies and then died quite early on, before the company had time to build up its reserves from the premiums it was charging. And so he concluded that in order to set up a company to offer long-term life, he would need a lot of finance up front to act as a buffer or a reserve. With this idea in his mind, he went and looked for like-minded financiers and wealthy individuals who would be happy to set the company up with him. Unfortunately, he died in 1757, so he wasn't around to see the formation of the company, but it was formed on his ideas. Richard Price, who was a minister, acted as a consultant to Equitable Life originally. He was very knowledgeable on actuarial concepts, and he looked at their premium pricing and advised them on how to price their products and so on. His nephew, actually, William Morgan, became the first actuary in 1775 and worked for the company for 50 years. The first actuarial valuation of the company was carried out a year later in 1776, and it was at this that William Morgan appreciated that there was going to be a surplus in the company. And this really came about because the method that they had used to price the products was based on mortality data that was national data, so included all different classes of individuals, whereas the individuals who were actually buying products from Equitable Life were the professional classes, and the professional classes, being individuals who had lived longer, didn't require their life insurance payments until a bit later in life, and so the premiums were slightly too high. And it was William Morgan who gave a method on how you might distribute that surplus, what we know today as a with profits or a bonus in a life insurance product. As the company got bigger, they obviously had enough data to be able to carry out their own mortality investigations to actually alleviate this problem. The 1800s and 1900s saw many more developments in the field of mortality. Notable ones are Gompert's law of mortality and the Gompert-Makeham range of mortality models that we have today. John Finlayson can be thought of as the first government life actuary, even though he didn't have that title in 1829. John Finlayson actually analysed UK annuities, and he made the same sort of conclusions that Haley had done earlier, which was that the life insurance annuities were being sold by the government too cheaply. In 1843, there was a very interesting activity when the many life companies that then existed at that point came together to share their mortality data to carry out their own mortality analysis. This is very much like the Continuous Mortality Investigation Bureau that we have today. But the activity was so successful that it's thought that that's what really led 5 years later to the formation of the actuarial profession, an appreciation that by coming together as different companies, even though they were in competition with each other, they could share their knowledge to improve the calculations and to make things more accurate for themselves. The profession formed in 1848, partly as a consequence of this coming together of different life companies, but also an appreciation that there was a public need for this now. Individuals were buying life insurance, and there had to be a profession to make sure that calculations were done appropriately and people weren't being overcharged for products they were buying. The products being so sort of difficult in terms of their concept and calculating them, there needed to be some profession that would be able to actually act as a communicator to individuals. Multi-decrement pension fund valuation was considered in the 1860s, and in 1952 Reddington published his immunisation paper. In the early days, actuarial education came about just as a purpose of the profession being a profession. So there was an entry requirement to join the profession, and that was on examination to become a fellow. The idea of a fellow existed right from the beginning. Early on, there were only 3 exams to be sat, and they generally were a mix of arithmetic, algebra, interest rates, life contingencies, mortality tables, and notably bookkeeping. And the profession maintains that sort of healthy audit trail attitude even today. Professional codes of conduct were introduced, particularly as more actuarial professions created in the various different countries. There was a need to bring those together to actually make sure that actuaries in different countries were of a similar standard, and so a core syllabus was developed across Europe in '98. In 2003, there were around about 150 universities teaching actuarial science as well. The core syllabus was really broken down into 4 stages. Preliminary stages were mathematics and economics and so on, just getting people up to a foundation level. The foundation stages were beginning to talk about actuarial concepts, annuities and so on. Generalised application stages took that one step further and talked about various products. And then you would have had country-specific levels, obviously taking account of the different regulation in different countries. And that hasn't really changed up to today. Those 4 stages are still really the same. Coming right up to the 21st century, um, in terms of education, we've had the Morris Review now. That was in 2004. And the UK profession has regularly updated the actuarial material, changing the names and moving things around, but they haven't really removed too much material. Universities in the UK have now become much more significant in terms of actuarial science. Very different to the concept in Europe, where universities were always involved. The Morris Review was a review of the whole profession, which was carried out after the collapse of Equitable Life. And Morris concluded that there were two potential routes for the profession to go: one of contracting or one of expanding. The contracting route was really to say that the profession should just focus completely on its specialties in life insurance and annuities and so on. And the expansion route was to say that the profession should realise or appreciate themselves as risk managers, and that they should widen the number of activities that they could carry out. Morris also noted that there seemed to be an element of protectionism in terms of the fact that there were these reserved roles within life companies and pension schemes that were for actuaries only. People had to be fellows of the Institute of Actuaries. And that didn't really sit too easily with the fact that finance had caught up and overtaken, in some senses, in terms of the techniques used to price financial products and concepts. One of the four main recommendations that Morris made was in terms of education. And what he noted was that there was a very low level of qualifying rates, and the length of qualification was quite long. He noted there was a lack of innovation, and that as a result of that, there was a restricted number of skills that were being developed. So he recommended that those things should try to be removed, trying to qualify people a bit quicker and to widen the education of actuaries so that they could move into non-traditional areas. An example of that is the CIRA qualification, or the Chartered Enterprise Risk Management Risk Actuary. The UK has moved the actuarial material around quite a lot in the last decade, 15 years, but really just tinkering at the edges, changing the names, moving material around. You can see definitely that from pre-2000, where there were only 7 subjects, right up to the situation today where you have to study 16 subjects from 26, that there has been some widening of the amount of material, and not too much is removed. One innovation that the profession has created is this idea of either being a fellow of the profession or a technician. The actuarial technician role has really been created as a way to make sure that people who don't get all the way to full qualified actuaries do still retain some form of actuarial qualification. I think there's also the appreciation that there's no longer a need for everybody to be a fellow of the Institute of Actuaries. There are lots of people who need to have actuarial skills to be able to do the calculations, who don't necessarily need to know the bigger picture or the bigger story, but they need to be competent as actuaries. The actuarial technician fulfills that role. That's still in a consultation phase at the moment, but the idea is that will come in within the next 2-3 years. Universities becoming much more involved in the UK anyway. It's not really a result of the Morris Review, but it has been accelerated by the Morris Review. The Morris Review in particular led to the idea of accreditation for universities rather than exemptions. The exemption method was basically a method where the university taught exactly what the profession recommended as education for actuaries, whereas the accreditation method really says to universities, you need to teach broadly the same as what we expect of our actuaries, but you can add more material, you can take things out that you think aren't necessary anymore. And currently there are 14 accredited universities under the Institute of Actuaries process, 2 of them being overseas and 12 UK based. In terms of future developments, the profession is trying to adopt a wider remit, so trying to move their actuaries into more non-traditional areas. And an interesting point that Morris picked up on was that was very tricky for countries like the UK that had a long tradition of actuaries being attached to life insurance and life products. He noted that in Australia, for example, where they didn't have that long history, that actually actuaries were being much more innovative and they were moving into areas that were very much non-traditional areas. So he definitely noted that for the UK it was a bigger task to widen the roles that actuaries might work in. More generalised risk management education, the introduction of CIRA and so on, has been an activity that the UK profession are continuing with. And engaging more with finance experts. There's a kind of appreciation that when you try to move into more general risk management roles, then you're in competition with finance experts. And so perhaps your ideas of discount rates and so on that don't really sit easily with finance experts, you need to find a way to actually engage together with those. The profession are keen on looking at capabilities rather than content now, so making sure that you have the rounded skills that you need rather than you have just all of this knowledge in your head. And there's definitely an appreciation that communication is the key rather than the mathematics. You need to have good mathematics, that's for given. But if you can't communicate that to the client, then you're not really of much use. So having the communication skills is a very important idea now. And in particular, universities that are setting up actuarial programs in the UK at least are setting them up in business schools rather than schools of mathematics for that reason. So just to finish, a couple of lines that the actuarial professions like to use: making financial sense of the future, using the past to predict the future. Well, I think in the case of education, perhaps we shouldn't always be doing that. We don't want to get too stuck in our traditional ways. We want to widen what we're doing as actuaries and to move into non-traditional roles. Then we have to let go of the past sometimes and look to a new future. Thank you.